Real Country 1430 AM and 107.3 FM WRDN. Brian Winnekins from the National Association of Farm Broadcasting Convention. Thank you to our broadcast sponsors, including Elsivia Co-op, Annabis Silo, Animal Wellness Center of Buffalo Valley, and Compeer Financial. Joining us this morning, Tanner Ehmke. He's the lead economist for grains and oilseeds with the CoBank Knowledge Exchange. He was at the Farm Credit Services booth at this year's convention. So we're going to talk about some of those grain markets. There's a lot going on. And I guess, Tanner, okay, so for 40-some days, we had absolutely nothing for stuff from USDA. Now we have a massive data dump. What does the data tell you?
Well, the first round of data that was released from export sales showed that we were really behind on sales to China. That appears as though to have been temporary. The Chinese obviously have been stepping in here in the last week, buying 1 million tons. And that's been an absolute positive for the market. And it was probably Chinese buying on the futures market that was lifting up soybean prices during this period. And now they're actually locking in shipping and freight and the actual basis. So absolute positive there. But there's a lot of data we're going to have to go through yet. We missed out on a lot of the crop progress reports, and that's not good. We need that kind of data, especially now that we're getting into winter wheat season here. We need to know the health of the winter wheat crop, so that's a positive also now that we've got that flow of data coming. But I'd say what we really were missing during this period was the sales data, the most important part during this period. We did have export inspections data, weekly data that's coming out Monday from FGIS, and that was good. But the sales part, that was missing. And so now that we're back online there, we're getting that transparency that we need. And going forward, we're going to have that window open again of seeing if China's going to be coming back and making more purchases. And we'll see if that happens. The window's getting pretty tight between now and January 1st. To fulfill that advertised 12 million metric tons. It's a pretty tight window to make that happen. We got 1 million down, 11 to go. We'll see if they're able to do that. We also don't know, though. Brian was in the details of the agreement. Nothing's been made public in terms of a public signing or anything like that that was agreed to officially. And so those details are lacking. So although we have lots of data now being released, some of the most important details are still missing, and that is troubling, especially when it comes to the trade relationship with China.
Let's look at that deal. I always put it as in quotes, trade deal, quote unquote, because if nothing is approved by Congress, this doesn't mean anything in 2028. And how is it enforced? And if it does get sent to Congress without Trade Promotion Authority, we now are subject to 535 possible amendments to these things. Are we getting excited about something that we really shouldn't be getting excited about?
You bring up a good point. A trade truce, we'll call it, or a de-escalation of tensions between U.S. and China. But those tensions aren't going to go away. We still have a lot of things to argue over for things like rare earth metals, semiconductors, things that geopolitically are probably on a higher level of negotiations than soybeans and grain sorghum sales. And so, again, as you point out there, with validity, a lot of uncertainty about where this goes next, with agriculture, being affected by some of these larger issues. I would say eventually China's probably going to have to come back to buy some measure of soybeans from the U.S. We don't know what that looks like going forward now that Brazil is probably going to be harvesting another record crop. But at the same time, we have other countries around the world that have benefited from this trade row between the U.S. and China that are vying for that market share in China. Countries like Kazakhstan, not a country that we hear a lot about. It's not like Brazil. We hear about Brazil all the time. Who is this country, Kazakhstan? They have millions and millions of acres that they can bring into production. They increased their oilseed acreage about 38% over this past year. 38%. We're talking about sunflowers. We're talking about rapeseed and some soybeans. And it's mostly the soft seeds, as they're called, sunflowers and canola or rapeseed. and they're adjacent to China. They're neighbors with China, and we missed them on the radar. And so they're increasing acreage. So my concern is that although we've had a trade truce with China, we could see a flare up of tensions again. And our competitors in Brazil and Kazakhstan and anybody else who's vying for market share could increase their acreage even more. And so my concern is longer term is we don't have a cooling of tensions. We're just kind of at a low simmer, if you will, and at any time it could reboil up again.
We are talking with Tanner Ehmke's lead economist, grains and oilseeds with the CoBank Knowledge Exchange. Had a chance to talk with him on the NAFB annual convention. With the crop harvest, and we're starting to get those numbers, are you surprised? Were there any surprises in yields, production, and all of that? Or was it lower than expected, higher than expected, and that caught everybody off by surprise?
I think you're talking about corn.
Correct.
I think USDA came out with a number that shocked everybody. If you looked at the private industry estimates versus USDA, there is a wide gap between USDA and what private industry is saying, or a lot of private industry analysts, not all of them. I think that their yield number 186 now is still record large. I think there's some opportunity for that number to come back a little bit more. There are years prior where USDA shocked the market when their final number from what they did in November. Okay. So I think there is some possibility. The USDA is going to be counting bushels. We're going to get actual harvest data in. I think this was telling, though, when you looked at ear counts versus and then the implied ear weights. There might be some more downside revision yet to come, but I wouldn't get too overly excited about that, Brian. It's going to get really hard to bring this corn crop down below 2 billion on the carryout. If you brought the corn yield down to 184 without changing anything else on the usage balance sheet, okay, we're still over 2 billion. And if you got to get down to 183 before you start seeing things below 2 billion on the carryout. So it's a big crop any way you look at it. We're still going to have a big carryout. I don't see USDA bringing it down to 183. My personal bias is that at best we might get down to 184. But that's still a ways away from where they're at right now. But anyway you look at it, we got a lot of corn out there. And then you've got some of these other crops. They raised the milo yield a lot. I know grain sorghum isn't what everybody grows out there. It's grown on about 6 or 7 million acres. But if you're in Kansas, that means something. We got some milo out there that needs to move. Grain piles all over the state. So I think USDA made a healthy move there on that yield. They didn't do much on wheat and soybeans. It was mostly on corn and grain sorghum, I think, for me personally, that I was looking at. They made a big increase on the milo yield. That was the right move. We'll see what they do on corn. I think they might get down to 184 at best.
So, Tanner, for corn and soybean growers in western Wisconsin listening to this going, now what do I do? Should I take the money I can get right now because prices have gone up a little bit? Or how do I navigate this?
Obviously, predicting the future is not easily done. We've had a good run on prices on soybeans. And I would say, given all of the uncertainties that we have, especially with trade with China, it hasn't resolved. We still have new crush capacity, though, coming online in the U.S. That is a positive. And given what I know about markets and what every farmer knows, high prices don't stick around for very long. If the market offers you a profitable price, that window is not going to stick around for very long. It's going to be a very narrow window. And if you are in a profitable space right now, most people aren't, given the high cost of production. But if the market has given you a profitable opportunity here, don't wait around. That window is going to close pretty quickly. Obviously, this is going to be dependent upon what happens in people's local basis. I understand that. So that needs to be taken into consideration as well. We are seeing some strengthening in basis because farmers are not selling. But we've also had a very strong corn export program, strong wheat export program, strong domestic usage on soybeans. And so that combined is pulling up basis. So there's an opportunity here to perhaps lock in some favorable basis. So I think you're going to have to look at the dual approach here. Find that opportunity on basis, and if the flat price is going to offer you something profitable, you better take it pretty quick.
I guess one final question. How is the macro economy, the general economy, going to play into all of this for the agricultural economy? If we would see a slowdown in the general economy, could that give some pressure to the regular agriculture markets?
The tie there, I would see, Brian, is with what the Federal Reserve does. And if the Federal Reserve is going to continue cutting interest rates. And Jay Powell is very clear in the last meeting of the FOMC meeting, don't expect it. Don't count on it. He was making very clear, don't bet on another cut because inflation is still fairly sticky. And that's a problem, right? The Fed's dual mandate is stable prices and full employment. Unemployment is ticking higher. That's not good. And the K-shaped economy is that everybody keeps talking about. The lower K part of the economy is getting worse. More and more people being out of work longer periods, job hiring slowing down, unemployment ticking up. So they're watching that, and that's clearly not a positive. But at the same time, you've got the inflation part. Prices of goods are coming up, but a lot of that is owed to tariffs. So they're stuck between a rock and a hard place. The market has expected that the Fed is going to be cutting rates because they've telegraphed that in their projections. But Jay Powell threw that curveball in the last meeting and said, don't count on it. So my personal bias is we'll probably see another couple of cuts. But I'm starting to get a little bit more cautious on that. Maybe they won't. I mean, they're getting concerned about inflation again, I think. So I think there's the tie here to a slowing economy is that, the slowing economy would give the Fed incentive to cut rates, but at the same time, inflation hasn't cooled down, and so that may give them some pause. I think the blackout on data during the government shutdown is another problem. They were missing a long period there of data, and so in this next meeting in December, they may skip doing anything on rates just because they missed so much data.
That is Tanner Ehmke. He's lead economist, grains and oil seeds with CoBank Knowledge Exchange from the NAFB convention. I'm Brian Winnikins for WRDN.